Today, we're looking at a global sell-off, escalating geopolitical risk, and shifting central bank expectations. The prevailing risk-off sentiment dominated the final session of the week. Market anxiety was heavily influenced by the ongoing Middle East conflict, which showed no signs of easing. This anxiety translated into a sea of red across major global equity markets. Focusing on the U.S., the market downturn intensified. Key U.S. indices recorded 5 consecutive weeks of losses, signaling sustained selling pressure. The tech-heavy NASDAQ is now officially in correction territory, marking a significant downturn from its peak. The sell-off was not limited to the U.S., with Europe also experiencing declines. Equities across Europe were broadly sold off, mirroring the global risk aversion. Moving to fixed income, we observed key shifts in the bond market. The U.S. yield curve steepened over the session, indicating diverging expectations for short-term and long-term rates. Front-end yields eased, while longer maturities edged higher, contributing to the steepening curve. This dynamic reflects how markets are balancing near-term growth concerns against potential medium-term inflation pressures. Domestically, the focus remains on the Reserve Bank of Australia's policy path. Markets have now priced in a terminal RBA cash rate of 4.85%. This heightened expectation suggests the market believes the RBA could hike rates another 3 times this year. Let's review the currency and commodity markets for the session. The US dollar strengthened, reflecting its safe haven status, while the Australian dollar softened. Oil prices surged once again as the market priced in a higher probability of a, quote, supply crunch driven by geopolitical risk. That wraps up our market overview. Continue to monitor geopolitical developments and central bank guidance for the path ahead.